Welcome to Moneywise Learning for Teens. We are on session 3 of our 12-session webinar series on financial education. I believe that school teaches you a lot of things, and I know some of the schools are doing financial education as well to some extent. But here we are, we want to make full use of this time we have at home and teach you how to be money smart, because all the things you want to do after school involve dealing with money, whether you want to go to college, whether you are going to start a business or you're going to start working. All of that involves dealing with money. And we want to make sure that we want to bridge that gap and make you ready for the real life after school and when you go to college as well. To do any of that successfully in your life, you have to learn to manage money well. And at the end of the day, I believe strongly that it's how you manage money which determines how wealthy you are. You can make a lot of money, but if you don't know how to keep the money, then we are not going to do very well. So just to give you a recap, I know there are some questions about where we are. Do we have a guest speaker? So the guest speaker is a little postponed. We are moving them down to the 6th session possibly. I'm not sure yet. I'm trying to line that up. Today we're going to complete, we talked about assets and liabilities in session 1. We talked about loans last session. We were talking about compound and simple interest, but I moved it to this session. So we're going to talk about simple and compound interest. And I know a lot of kids have done a lot of work on this at school. So we're going to test your skills there and also apply it to the real life, like what kind of loans carry simple interest on them, what kind of loans carry compound interest on them, what to expect when you go out there, right? So we'll talk about that today, and the rest of the sessions you can see on here. I want to highlight the last session, the 12th one. We will get at some point, I don't know which in the series it will be, but we are getting a guest speaker for that one as well. So he'll be a college planning expert. They are basically career counselors, college counselors. So we will get them on, and we especially welcome our high schoolers and their parents as well for this webinar. So you both can learn from it. And the sooner you start preparing for college, the better it is, because you do want to build your resume, right? Almost all of you guys know us, so I don't want to spend too much time on introductions. A quick introduction to Anar. She's on the call with me today. So she is an entrepreneur and an apartment investor. She runs a company called Lotus Capital, and she does webinars for ages 5 to 10, which will be at 3 p.m. Central tomorrow. If you have brothers, sisters, siblings, friends who want to attend, please look that up. I am Kavita Bartake, and I'm also an investor, and I run Cherry Street Investments, and I do the webinars today. Quick rules, ground rules, please ask the questions. If you have any questions relating to the topic we're discussing, please ask them. Find the Q&A box. And no chatting with other kids, no spamming, please. And the chat box is only used to talk to the hosts. Please, if you want to play Fortnite, any games, you want to talk to other people, please keep that after we're done with the webinar here, okay? We will get to the questions at the end of the discussion. So I know a lot of people ask questions as the discussion goes on. Feel free to type those questions in the Q&A box, but I'm going to move the questions to the end if I can today, because it kind of derails the amount of time we take to finish through the material. So quick question here. Last week, the assignment was to talk to your parents and use their help to put together what kind of loans they have, go online and look at mortgage, car, and other calculators, discuss with your parents what kind of loans you might be potentially taking once you go to college, which was college loans, car loans, what kind of interest rates they are being charged right now for these kinds of loans, and work out how much it cost you monthly. So a quick poll to see how many people actually did the assignment from last week, and also how many people played the game Cash Flow online. So I'm seeing 71% voted. I'm still waiting for the counts to go up. Did anyone not see the poll yet? I just pushed out a poll. Awesome. Okay, so it looks like about 57% of you did the web, 54% rather did a little bit of the assignment, or most of all the assignment. Some of you did a little bit, 25%, which is pretty good, and 21% has not done the assignment. I want to emphasize that unless you do the assignments, learning here is not really going to help you much. We expect that the assignments is something that will really teach you what your friends are doing and what your family is doing, rather your parents are doing, and that'll give you a better idea of what we're talking about here, because this is just a lecture. I don't want this to become the actual learning. The learning is when you actually go home and apply it to what your parents are doing and try to understand what they're doing. About 44% or 52% of folks have looked at the webinar, looked at the cash flow game, I'm sorry. And some of them loved it. 8% didn't like it. 6% saying, what's that? If this is your first webinar, don't worry, we'll catch up. Today, I hope to spend a little more time going through cash flow because I don't have a whole lot of lecture time planned. Some of them said, 42% said, no, I didn't get a chance to. I highly suggest you go play that game. So you'll get to understand a lot of these concepts we're talking about there as well, okay? All right, now let's do a quick review. So we talked about this. We talked about your homework assignment. Sorry, give me a second. My mouse is in the wrong screen. Hey, Ryan, can we not talk about Fortnite here, please? So, quick question for everybody here. What were some of the lessons you learned from your assignment and or the game in the last week? The last week's assignment. Can you share some of the learnings? You can type it in the chat box. Spend your money wisely, buy stocks when they were low. We didn't really talk about stocks, but okay, cool. I learned my dad's monthly pay, and I like this, and down payment. Yeah. And is this for the mortgage, Vic? Be careful with loans, try to gain more assets. True. Life is unexpected. That's true. I think we're all learning that in this crisis. Loans are great. Yeah, loans can be good. It just depends on how you're managing your money. Loans can be a pain in the butt. I don't know about that, but loans are good, especially right now. Think about all the businesses that are hurt when the COVID crisis, right? Don't you think those businesses need loans to make it through? And that's why the government has allocated like $360 billion. They're printing a lot of money right now. Have people heard about the government stimulus? Because they have to bail out all these businesses and give them loans. So loans can be good. Businesses need loans to tide over a downturn, or when their business is not doing well. Think about all the restaurants which have closed and all the businesses that are hurting right now. So loans can be a good thing. I learned, Mihir says, this is a good one. I learned what loans my parents have, such as a mortgage loan. Perfect. That's exactly what we want you to do. We want you to go back and learn about what kinds of loans are out there, what your parents are taking in terms of loans. So loans are not a bad thing, guys. As long as you have your down payment covered, you can buy an asset. That's true. That's a good point. Long term is from the government and treasury. Yes, yes, we have the long term rates, which are determined by the treasury, and the short term loan rates are determined by what's called the Federal Reserve. Unless you're getting a cash flowing thing, don't get too many loans. This is a great point, James. You don't want to just get loans and be stuck with a bunch of negative cash flow, right? You don't have enough money. You're losing more in expenses than income. That's not the place to be. If you want to get loans, you want to make sure that you can cash flow with those loans, right? You're making more money than you're getting in loans. Daniel asked, can I send a link to cash flow? Yes, I can. Usually after this webinar, everybody gets an email with all the links to the game and today's assignment. So it'll be sent out. Okay, great. Thank you for sharing your insight into last week's lesson. So I just wanted to quickly do a recap for those of you who didn't attend last week. Every loan has a principal rate and time. A lot of you have learned about PRT, interest and using principal rate and time. Principal's amount, rate is the percentage you're charging on the loan, and time is the amount of time you're holding the loan for. We learned the different types of loans: mortgage, home equity, auto, and more. We also learned about open-ended and closed-ended loans, which are open-ended are things like credit cards, which give you a line of credit, but you don't have to use it all at once. You just use it as you need it. And close-ended are when you actually take a loan out for, let's say, a mortgage. You actually borrow 200,000, then that's a closed-ended loan. What affects loan rates? The short term, it's called the Federal Reserve Fed funds rates, and long-term loans are affected by the 10-year treasury notes, and other loans are based on what the bank wants to charge, and that's in turn based on the prime rate, and the prime rate is sort of affected by the federal funds rate. So does anyone know, this is a trick question, does anyone know what the current federal funds rate is? Anyone wants to type it in the chat box? What is the current federal funds rate? The Federal Reserve changed it. Yes, that's right. David says 0.25, half a point, a quarter of a point actually. So right now it's 0.25. A month ago it was 1.75. So the Federal Reserve has slashed the rates recently because of the condition that we are in. So it makes lending cheaper. Like banks basically get money at this rate, and they add on their own, their own cost on top of this federal funds rate. So it's actually 0.25%. It's really low. It's almost zero. And we're actually expecting it to go even negative maybe in the next few months. So let's come to today's lesson, simple and compound interest. I think I asked last week, but how many people have already learned about simple and compound interest? And I expect it to be a big portion of this class. You're going to raise your hand. Okay. So a lot of people have learned about it. This should be an easy one, and there's going to be a quiz. So pay attention because there will be a quiz, and I expect you guys to know this because you've done it in school already. So it'll just be reinforced today, okay? So what is interest? Interest is the cost of borrowing money. So when you borrow money or you lend money to someone, you're going to charge interest. So you'll either pay interest or get paid interest on the money you borrow and lend. Banks pay interest on money that you put in your savings account or money market account or any kind of account. They have a certain interest rate that they pay, right? So banks also charge interest on the money you borrow from them. For example, you get a mortgage, you get a car, you get a personal loan, they charge the interest on that money. So the type of interest that the banks charge can be either simple or compounded. So let's talk about when we do a simple interest loan or when we do a compound interest loan in the next few slides. And the other term I want you to understand is the down payment, is the amount of dollars or dollar amount that you expected to pay before a bank pays a loan on a car or a house or anything else. So for example, let's take an example of a car. So your bank says, okay, your car is $20,000. The bank says, hey, I need you to put down some skin in the game. So I want you to put like $2,000 down, and I will finance $18,000 of a $20,000 loan. So that way the banks make sure you have some money in the game and they lend the rest of the money. So that's called the down payment. And that's usually true in most loans, especially car, mortgage. There's a certain percentage that the bank will need you to put down as a down payment. Let's talk about simple interest. There was a typo there. Simple interest is the interest is only placed on the principal. So you easily calculate the interest using the principal, interest rate, and the loan term. And simple interest generally costs you least for a given principal term and rate, and compounding will cost you more because the interest in compound interest is not just based on the principal, it's based on principal plus interest. And we'll talk about that in a second. And simple interest is generally used for short-term loans. For example, let's say you have a car loan. You take it for either 3, 5, or maybe 6 years max. So those interest rates are usually calculated as simple interest. And simple interest loans can be auto, personal loans, and some student loans. And you want to be careful when you take a student loan, because you want to calculate the cost of actually taking that loan. And that's when it's very useful to understand how the loan is, whether it's a simple interest loan or a compound interest loan, or what kind of interest rates they charge. So simple interest is, in a simple interest, you calculate simple interest as principal times rate times time. The time is the number of years. So the actual amount that you end up paying is the principal, which you borrowed, plus the total interest that you paid. So let's take an example. We have principal of 5,000, a rate is 4%, and time is 3 years. And I'm sure a lot of you folks know this already, so I'm kind of preaching to the choir here, but I just want to do a recap because I'm going to do a quiz for you guys. So simple interest in this case is 5,000. Your rate is 4%. When you convert the percentage to a decimal, so you're dividing 4 by 100 times 3, which works out to 600, right? So your amount now is 5,000 plus that 600, which is 5,600. So you basically paid over 3 years, $600 in simple interest. So what's your payment per month? Your payment per month is 5,600 divided by 36, which is the 3 years, right? 12 times 3 is 36. So you're actually paying 155.56. The reason I want to talk about this is how your car loans are calculated. So you should understand how simple interest works. If you want to do a quick math, you can go to Google and type auto calculator, and it'll pull up this simple interest calculator for you. So let's talk about an example for simple interest. Actually, I'm going to skip this one because I want you guys to, you're going to do this in your quiz. So I'm going to skip this. Let's talk about compound interest. Compound interest is calculated on not only based on the principal amount, but also the accumulated interest of the previous period. So for example, let's say you have a compound interest loan. Every month there's a certain interest rate, right? Let's say you have a 4% rate, you divide that by 12, and every month you're paying that particular amount of interest. But now the interest builds up from the previous period. So if you take it in the 6th month versus the 5th month, it's a different amount of interest. So you're paying not only on the principal amount, but also the accumulated interest. And therefore, it's an interest on top of interest. So it's compounding. So compound interest is generally used for long-term loans. For example, your mortgage loans, your credit card loans, anything you borrow on a credit card, and some of the students' loans are also compounded. So you have to be careful when you go out there and take a loan when you're in college, and make sure what kind of interest rate and what kind of term and what kind of, whether it's simple or compounded, you want to calculate and make sure you understand what your payment on that over a period of time will be, not just when you take the loan. So if you're doing a 15-year loan, a student loan, then you're paying a lot of interest over the time of the loan. And sometimes it might make sense for you to pay that loan off sooner than later. So we will talk about this mortgage example. Sorry. So again, we'll get to these questions. I want to skip this right now. Sorry, I should have canceled this. Let me skip over this. And let's talk about how it's compounded. So we have a principal of 5,000. This is a compound interest, right? A compound interest is calculated as principal times 1 plus rate to the power of time. So that's essentially what you need to remember. You can do it you can do it manually, or you can do it using a calculator. It doesn't really matter to me. I just need you to understand how this works. So you can go online for a loan calculator, look it up. So example, let me see if I can show you an example here. I'll just share a quick loan calculator here. So your principal is 5,000. Your rate is 4%. Your time period is 3 years. So what's my monthly payment? So let me see if I can quickly share a screen with you. Give me a second. All right. So let's use a compound interest calculator here. So let's do this bank rate one. I'm more let's just go to Google. So Google has it in the mortgage interest calculator. So let's say I take $5,000, which is very unlikely for a mortgage, but I'm just trying to calculate a short period right now. So let me take actually a real mortgage. So 200,000, let's say the interest rate is 3%, and we're doing a 30-year mortgage. That kind of shows you what the monthly payment for that mortgage will be. But what's even more interesting is to look at what's called the amortization schedule, which actually shows you how much interest you pay over a long period of time. So let's say I have a mortgage amount of 200,000. And can everybody see my screen? I just want to make sure. Okay. Hey guys, I'm gonna block you talking from to each other because you're abusing this again. So please, I will make you guys just talk to me. You don't want that. So if you want that, please talk to each other. Otherwise, please cut the crosstalk. Okay, so here. Now we have 360 months, which is basically 30 years. And we have, you can enter in months or years. So I'm just going to calculate. So you can see the number here, the total principal paid, and you can see the amount of interest you end up paying, which is, looks horrendous, right? It looks like a lot of money. And this is why sometimes you want to, if you see the initial part of this, how interest is calculated, the amount of interest you're paying is huge compared to what's going towards the principal initially, right? When you start the mortgage or start the compound interest payments. But over a period of time, your more and more starts going towards the principal and less towards the interest. But if you start looking towards the end of the loan, you start seeing the point where you're actually paying a lot towards the principal and less towards the interest. So what you do want to make sure is that when you're taking compound interest loans, you figure out the cost of actually taking the loan, which is the total amount of interest paid, and try to pay it off sooner when you have some simple interest ones or loans versus compound interest. Obviously, you're going to pay off the compound interest loans faster depending on the interest rate on those. Not always. So with that, I want to do a quiz, and I really need you guys to be focused here and cut the crosstalk, please. So let's quickly share. I'm going to share how you can join the quiz. And you can use a Google calculator. You can just look up simple interest calculator or auto loan calculator on Google, or look up mortgage calculator. So please join this link, joinmyquiz.com. The code is 753083. Let's see what's going on in the chat. Okay, I think I'm going to stop you guys talking to everybody. Okay, that's it. So you cannot talk to anybody but us now? Hey, Lou, sorry, you can't talk to anybody now. Okay, thank you. Because you have been talking to everybody and I explained the rules earlier that you cannot talk to other kids unless it's about the classroom related topic. Thank you. All right, please join my quiz. All right, I see a lot of people there. Joinmyquiz.com. Code is 753083. If you need it, it's right here. Hey, Sanjeev, sorry. So I suggest you just go look up an auto loan calculator. It's fairly easy. We don't expect you to actually type in things and do it on your paper, but I'm happy to review it with you later, okay? So please join myquiz.com. Code is 753083. I think lots of you are there, so I'm going to go there now. Okay, I see a good number of kids. I'm going to start this, okay? So you'll have a certain amount of time to answer each question. So please go. Hey, Liam, I'm sorry you got disconnected. We are on joinmyquiz.com. We are doing a live quiz here. And the code I'm going to share on the screen right now. Hey, Sanjeev and Arya, if you want to send me an email, I'll set up a call with you and go through it again with you. All right, let's see. where we are. If you're done, just raise your hand so I can see when most of folks are done. I'm sharing my screen right now. You guys can see the leaderboard. I think Ria and Arya are almost done. I think Arya's done. Good job, Arya. Ria is, I think, done as well. Is anybody not done yet? I think there are some more people who are not done. I'll give you a few more minutes. Hey, Arya, I will help you after the class, okay? Okay, good job, Arya. So once everyone's done, we will go through the questions and work it out, okay? So I just use the Google calculators for car loan and mortgage, and I'm going to use that for the examples just to walk through the questions. Can you raise your hand if you're done? I just want to see how many people are done. You could go to the Zoom and raise your hand. Okay. And I'm going to continue once I see enough hands come up. Okay, got it. I think most people are done. All right, you should be able to see my screen right now. Arya, good job. I think Arya topped the quiz, and Akshat, Riya, Christella, and Anar. Anar, are you playing? Are also on the top. Good job, guys. All right, let's look at the questions really quick here.
Thank you, Kavita.
36 people got this right. So it's pretty simple, 6.75 to decimal. You move up, divide by 100, right? So you move up 2 decimal places, it's this one, right? 0.0675. The second one, the simple interest calculator, the simple interest formula is interest equals principal times rate times time. The P represents the principal. The principal is the amount of money borrowed or deposited, right? That's what the answer is. What is the correct definition of interest? Most people kind of got that right. It's money paid by the bank for the money you have saved with the bank, the money you save in the bank, the money you borrow from someone, none of the above. So these were kind of trick questions. The money you save in the bank and the money you borrow from someone is like the principal. It's actually the money, right? The money paid by the bank for the money that you have with the bank, that's what interest is. So that's the correct definition for the interest. Jerry borrowed 4,000 for 5 years at 6% simple interest rate. So simple interest is PRT divided by 100. So let me just take my quick auto calculator here. So Jerry took 4,000 and 5 years at 6%, right? So we have 4,000. We take 5 years, which is actually 60 months at 6%. So how much interest does he pay? This is monthly payment. The total cost of the car loan is 4,640. So he's actually paid $640 in interest because 4,000 of that is his loan amount, right? So how did I have an answer here? Did I make a mistake here? Can anybody figure out what I did wrong here? Is it 4,000? 5 years, 6%. That's right. Anar, what did I do wrong here?
I think you should ask Riya, right?
I was like 4,000, 5 years, 6%, 6 by 100. Now I'm doing it manually here. 6 by 30, 30 times 40 is 1,200. Why did this calculator is wrong? Okay, it's 1,200. Okay, the right answer is 1,200. I don't know. It's just principal rate, PRT divided by 100. Okay, that's the interest. It's 1,200. For some reason, the calculator did not show the right answer.
That's actually a good learning, right? That better make sure your calculator is coming from a good website or so.
Yeah.
Yeah.
All right. How much in total does he borrow from the bank? Now I don't think I should use the Google calculator anymore. So let's do simple interest equals principal, which is 1,200. Rate, it's 8 by 100. And year is 2, right? So it's 12,000 times 8 times 2 divided by 100. So what is that? 2,400 times 8. Someone wants to tell me? You just use a normal calculator. Okay. 8, 4, 2, 3, 8, 2, 16, 15, 16, 17, 18, 19, 19. So 19,200 divided by 100, which is 192. So he pays 1,392 because it's 1,200 plus 192 that he has to pay back. So your amount is principal plus interest, okay? After graduating from college, Peter decides to buy a car for $23,000 from a dealership. His bank asks for a down payment of $3,000. What is the loan he needs to get? The loan he needs to get is 20,000 because the down payment of 3,000 is removed from this principal, which is 23,000 is the total amount he needs. So his principal is actually 23,000 minus 3,000. So the right answer is 20,000. Okay. After graduating from college, he besides, it's basically the same question. Now his down payment is 3,000, but you have some interest rate and term here. So what is this car payment? So I actually use the Google calculator. If somebody can cross verify it, that's what I used. So his loan amount is 20,000. His interest rate is 3 and his term is 5 years, right? So 60 months. So 359 according to Google, that's the right answer. So the next one is Rohit is buying a house for 200,000. His bank approves him for a mortgage on his house with a down payment of 20%. How much money does he need to have as a down payment? So your down payment is actually 20% of the entire cost of the house, which is 20% of 200,000. That's $40,000. If anyone didn't get that, please ask questions, okay? Okay. Further, to build on that mortgage question, what is his mortgage loan amount now? Because he's putting 20% down, you have to remove that 40,000 from the 200,000. So he's actually taking a loan for 160,000. Okay. That's the right answer. Rohit is buying the same thing. He's buying a house. Now it comes up with the interest rate of 3%. So what is his monthly mortgage payment? So I go to a compound loan calculator here and plug in the numbers, 160,000, 3% for a 30-year mortgage, right? This is in years. So his monthly payment is 675. That's the right answer. Okay, if anyone has any questions, I'm happy to help you offline. Now we will do a quick, what are we doing next? Let me see, sorry. So I want you to explore some calculators on your own. I am sharing the wrong screen. Give me a second. Here. So I want you to explore these calculators. I found the bank rate one's pretty accurate. So you can check out the auto loan calculator, college loan calculator, and mortgage calculator on bankrate.com. For the simple interest calculators and compound interest, you can even use the formula that we spoke about here, the compound interest formula and the simple interest formula, and plug it in and cross verify and make sure the numbers line up correctly. So your assignment for this week is to talk to your parents about what you learned today and figure out, okay, some of you have already done this. What kind of a mortgage do they have on the house? Like, do they have a 15-year or a 30-year? I want you to look at your house mortgage statement and figure out what goes into the mortgage payment. So what I want you to learn about is what is PITI and escrow. This is a little beyond what we've done in the class, but it's useful for you to understand that your mortgage payment is not just principal and interest. There are other things which go into your mortgage payment. So I want you to find out what that is, because when you own a house, you have to worry about those other things as well. I also want you to find out what other kinds of loans they have, which you might have done last week already. But now I actually want you to go to the statements that they have and look at the statements and figure out what kind of interest rate they're paying. Is it simple or compounded? And last one is understand the difference between interest and APR. And I'm going to ask a question next week about this. So understand the difference between interest and APR. Does anyone have any questions on that? The assignment for next week? Or anything we did today? Okay, so you are not able to talk to each other right now. So whatever you type is something that we are seeing, just me and Anar. So just FYI, because we had a lot of disturbance in the class today. So if you don't have any questions, I have 10 more minutes. So we're going to go to cash flow really quick. Okay. Assignment of the week. Don't worry, I'll send you an email with the assignment so you don't have to take a screenshot or anything. So We will talk about, we will send this out so you have access to it. Let's just do the game now since we have very little time left. So if you guys want to follow me, just look for Cash Flow Classic, Google Cash Flow Classic. You should go to the link. So I already have an account. If you might need to create an account. So if you have an account, please log in. And I'm going to, if you have some rooms created already, then feel free to join that room. If you have a room and you want to share it with other folks, I'm going to open up the chat right now so you can share your room with your friends. So right now, if you type it, then, hey, Pari, I got it. I will send the assignment out, Pari. Okay, so please log in here. So if you can just set it up as MLT1, MLT2, and so on. I want to play this game for a little bit with everybody so you guys get a chance to figure out how this game works. And if you have not already played, at least we can get it started. And if you have any questions, please type it in the chat box. Hey, Daniel, I want you to find out what APR is. That's your homework, okay? It's fairly easy, but you need to dig in and do some Google searches and figure out what APR is and come back next week with it, okay? So is anybody in the game yet? Okay, I have a room. It's called MLT1. Okay, Navya, are you here in my room? Because only 6 people can join this room. So you have to create your own rooms after that. I don't know how I could see who's in the room besides me. Can anyone figure that out? No, I don't want to quit. Can you look up MLT? What was this? I can't even exit now. The web page is, okay, here, richdad.com/product/cashflow-classic. Are you serious? It doesn't let you look it up? Okay. So then just create your own room and go into your own room or join an existing room. Doesn't really matter. I just want you to play. The best way to get to Cashflow Classic is to just Google Cashflow Classic in google.com. Just say Cashflow Classic and it will take you to the website. That's probably the fastest way to do that instead of typing in the URL. Oh, I am sharing it on my screen. I don't know if you guys cannot see my screen or am I not sharing the right window? Let me make sure I am. Sorry about that. I thought I was. Okay, I'm sharing the screen. And I'm going inside right now here. Hey, Pari, I don't know why you cannot play. Maybe your parents can help you. So does anybody have a room created that I can join just to illustrate so we can play against each other? Arya, I see you started one thing. Game is hello and the password is hi. Where is hello? Hello, I don't see your game. It's too bad that we don't have a search here. Maybe you guys can make this game better. I can't see a hello game. Sorry. I'm trying to scroll. Oh, there it is. Oh, shoot. Okay. Can I join that? Okay. Password is hi. Okay. I think I joined one of you guys' game. Incorrect password. Is that the right one? We are a room called Cherry that's already started. Okay. All right. Cherry. I saw Cherry somewhere. Okay. I want you to start playing the game and rolling the dice. And I talked about, let's see. I thought I saw Cherry. Now I can't see it anymore. Oh, did you cut out the Cherry game? Aryav, password, cash. Okay, Aryav, I see your game. I'm going to join your game. Let's just go with it. Okay, password is cash. Hey, Navya, if you want to leave, that's fine. If you've already played the game and you want to leave, that's fine. Okay, so I think I joined Aryav's game, so I'm gonna play. What? Ah, okay, so this is not very efficient. I'm having a hard time. So I'm just gonna create a new room, because I think you have to also click on this to make sure everybody can join. It's like hell. All right. I'm going to allow 6 people, right? So I'm the first game person. So just look at this, right? So all you have to worry about is your financial statement here, the amount of cash you have, the total income. That's the amount of money you make every month. And your total expenses, the amount of money you spend every month on your regular expenses, which includes taxes, mortgage payment, car loan, credit card, and others, right here. So every payday you get after your expenses, you get to make 1150, and that goes into your cash pile, right? And the idea is that you need to increase the number of assets you have and reduce your liabilities. That's the point of the game. And the point of the game is also, besides this, and this is how you pull your financial statement, is to, this is called the rat race. This is where you have to keep making money to stay in the game, right? When you make enough income here with assets, you make enough income, passive income, it's called passive income, that it pays for your expenses. In this case, my expenses are 1950. When your passive income here, it'll keep moving up as you buy assets. And once your passive income reaches 1950, you are out of the rat race. So when you go out of the rat race, you go from this circle, or whatever this part of the board, to this one. So you escape the rat race. So that's what it's about. So for example, now I'm ready to roll the dice. I'm going to roll, right? And it says I have a small, what kind of deal type? And considering the amount of cash I have, I obviously cannot buy a deal which is $6,000 or more. So you want to look at the $5,000 or less. So I'm going to go with a small deal, right? And now I have an option to buy a stock, and it says the cost is 30 and the cash flow 0. The trading range is 5 to 30. And the shares owned are 0 right now. I don't have any, but look at the trading range, right? It's 5 to 30, and the cash, it's costing me $30 per share right now. Should I buy this? So is someone want to answer the question? Should I buy this or should I not? You can type in the chat box. Is this a good buy? Yep, not a good buy, because I'm pretty much on the top of my trading range. I'm buying it at $30, and the top of the trading range is $30. So there's no chance for me to make any money here. So I'm going to pass on this deal. So this is kind of how I keep going. And it says, at times you might say, hey, if I have a lot of cash, maybe I'm going to pay off some of these mortgages or some of these credit card loans or retail debt. So it's asking me here whether I want to repay it or borrow money, which I don't want to do right now. So I just keep going, right? Whenever my turn comes up, I get to roll the dice, and I get to do something something like, okay, now I want to donate to charity. If I donate 10% to charity, which I don't really have much money to donate, I get to roll the dice more than once. So I'm going to pass on this right now. I don't have any money. When I do, I'm going to donate more. So I keep going, rolling the dice. Now, notice that your cash value went up because you actually crossed payday and you made extra cash here. This is 1150 added to your existing balance of 480. Okay, so now I have an opportunity to buy a house for 135K for a 3-2 rental house. So the buyer has their own financing. If you sell, pay off the related mortgage and give up the cash flow you're currently receiving. So this is when you already have an existing house and they are giving you an option to sell your house because somebody is offering you money. So let's say I had bought a house for $100,000 before, then I could sell this house at this point, but I don't have any assets here. So there's nothing really for me to do. Okay. So I said done and keep going. I rolled the dice again. So now it's asking me if I want to pay. I don't think so, not yet. I don't want to pay any loans right now. So I'm going to roll the dice again. So I have an opportunity to buy a deal again. I just want to show you one deal. So I have an opportunity to buy stock. Ooh, this looks really bad. Record share price for $40 and the trading range is 5 to 30. Do I want to buy this? Anybody? Nope, I don't want to buy this. Thank you very much. It's higher than the trading range, the normal trading range. So I have no money I can make here. If I buy it for $40, I can't sell it more than that likely, right? So what I want to do is I want to buy it for $5 or $10, not 40. So roll the dice again. What deal type? I want a small deal. And notice that your cash value keeps going up, right? At this point, could I go repay some of my debt? Yes, I could. I have $3,900 sitting in the bank. I could go pay off your loan, your retail debt or a credit card loan or a part of a credit card loan. But you don't want to clear out all the debt necessarily until you have a lot of cash because you want to buy deals in the game because the deals are what is going to allow you to retire from the game or retire from the rat race. So you want to invest into deals and make passive income. Okay. So I'm going to go with a small deal. So I have a stock here, I think. So it says it's $1,200, cash flow is 10. These are called a dividend stock. What happens with the dividend stock is when you buy them, you not only get to maybe sell them at a higher price, but you also make some money every month from the cash flow for the stock. So 12, should I buy this? What does everybody think? $10 cash flow is not a whole lot, but would you buy it? Okay. So someone says, yeah, we could buy it. I don't know how much it's going to go up because the trading range is not pointing to telling me that it'll go up some more. But let's say I buy just one. Okay. I get $10 a month. The rate is pretty low. It's like $120 a year. That's not too bad. I'll buy it. All right. So I'll roll the dice again. So I'm going to buy a small deal now. So this is cool. So this was cool. So the stock split here, but I don't really have that stock. So I have nothing to get here. I'm going to roll again. Uh-oh. Now you have a liability here. Your child expenses have increased by $170 because you just had a new baby. So your expense is going to go up now. Your monthly expenses here, you'll add the child expenses of 170, so it'll go up the next time. So this is kind of how you play the game. I just want to do one small deal and let you guys do it after that. Again, I don't know if I want to buy the stock at $40 when the trading range is 10 to 30. So I'm going to pass. I just want to do one real estate one and then, oh gosh, I'm getting to buy new clothes for $250. Great. So I have to pay. I don't have a choice, right? So, okay, I'm going to do a small deal. Let's see what happens. Yeah, finally, I got a house. It's for $50,000 and I make $100 a month. That's awesome. I think I'm totally going to buy this because Let's see, down payment is 0. This is like a no-brainer, right? So I'm going to buy this. So what I want you to see now is your financial statement has a house under assets, right? And the cost of the house is $50,000. Now, there is going to be a mortgage, obviously, on the house. So your liability is also $50,000, right? But the idea is that whenever you get cash, you pay for the mortgage, right? So now I have a little bit of cash left. Maybe I'll try to pay off the retail debt. So I'm going to say repay. So I can pick the debt here that I want to repay. So pay off $1,000 loan amount of retail. I say yes, pay. So what's happening here is your cash value reduces and your retail debt is now gone from your list of liabilities. So what you're doing, guys, here is that you're reducing your liabilities, you're adding to your assets, and that's the point of the game. And you see here, you created a passive income of $110. And the idea is to keep increasing the passive income until it covers all your expenses, which now include having a child. And this is very reflective of real life, because as you get older, you get more expenses onto your balance sheet or your income statement, because you have more liabilities creating those expenses, and then you have children and other expenses coming up. So any questions from the cash flow game? I expect you to play this on your own. I don't want to sit here. I just wanted to walk through and show you how it's played, but I expect you guys to play this on your own time, and let me know if you have any questions. What you understand from this is stocks, real estate investments. You'll understand what it is to buy and sell stock, like how you can make money doing that. Any other questions before we wrap up today's? I think we are a little bit over, so thank you for staying in here. I am going to do a quick poll and let you guys go after this. So please let me know if you have any feedback, because that's how I can make things better and make it work for you guys. So if you have something you didn't understand today, if you want me to go slower, because if I go too slow, I'm just worried that some people will get bored. So I kind of have to figure out what pace I should go at. And today I decided it'll go a little bit faster because a lot of kids have gone through simple and compound interest. So please submit your poll or your feedback on the poll. I just started a poll. So our webinar starts 4 p.m. Central every week on Monday. And next week, we're going to talk about insurance. We're going to talk about health insurance, life insurance, auto insurance, home insurance, property insurance, renters insurance. So we want you to be aware of why we need insurance, what kind of insurance is out there, and what kind you'll most likely be taking for your, let's say you go to college, you rent a house, you buy a car. Very soon, when you're going to high school, you'll start driving a car. What kind of insurance do you need and why do you need it? So we're going to be talking about that next week. Thank you for joining us today, and thank you for your feedback. Have a great evening, and please look at your homework. And also, last but not least, please join us on Facebook if you're not already there. We post everything on the Facebook group. You can ask your parents to join us, or if you think we can do an Instagram group, I don't know what's out on Instagram. I would love to hear that, which will help us talk offline better, all of us. So this is the Facebook group that I have right now, but if you think you want to do some kind of Instagram group, I'm happy to set that up. Otherwise, I will see you guys next week. Thank you for joining. Yeah, I'll find out about Instagram. My daughter can help me. And I'll set maybe a group up or something up on Instagram that you can all join, and I'll post stuff on Instagram as well. Okay, bye.